Welcome to a new video on my channel. I hope you're doing fine. Today I want to give you an overview about the Q1 2023 numbers of Chargepoint. And since they have a fiscal year of January 31, let's do a mix up for the naming. So it's Q1 2023, even though we are in June 2022. So I think a few of the slides are worth noting, and the first one is here, slide 5, where they have the investment highlights. They say they have a strong electrification trend right now, especially with the ongoing problems in the war in the Ukraine with Russia, and the developing energy crisis and food crisis and whatever you name it. So this is something definitely where the world has to look for different alternatives from Russian oil and gas. And then something I want to point out as well is the capital light growth, as they call it, with minimal capex needed to scale business and recurring revenue with strong margins. So keep this in mind because I want to come back to this later. And now we go in, they show their business model as well, their growth projection for the future. And but noting over here, they have around 190,000 activated ports with more than 12,000 activated DC ports. So keep this in mind for the future, for reference, how many ports they have and what their development is over here. Nothing really compared to the last earnings, because it wasn't that prominent and hard to analyze in general. Therefore, it's not really worth to mention it right now or compare. I give an overview about the different segments of their revenue and also their businesses. You can have a look at it in detail if you want. And they show their platform, where the ecosystem is coming into, and I think the partners, they highlight them as well. And this is nothing I want to dive into that much. The first one is their recurring revenue, as I said, it's around 49%. And this slide didn't really change in comparison to their initial investor presentation. So it's still the same. Not sure if they didn't update or if there's no change, but I think it's the latter. So most of it, well, almost half of it is upfront and the rest is recurring. So this is what they mean with recurring revenue. And then the most important part right now, I think, is the revenue on one hand and their diversity. As you can see, it's almost 100% growth from the Q1 2022, and they had 241 million in revenue in 2022. So, and as you can see right here, most of their revenue comes from the network charging stations, and they have subscription and support. I think it's around 10 million, and then the rest, I think it's between 1 and 2 million, is the other services. So now let's have a look at the initial investor presentation to compare these results. So you can see here 241, the fiscal year 2022 results for the revenue, and they had a forecast for 347 million. So it's almost 70%, only 70% of this revenue. And if we jump now here over to the guidance for the fiscal year 2023, and which is between 450 and 500 million. If you compare this right now to the number which they projected in the beginning of around 600 million, this leads to around 74% up to 83%. So it's an increase to 2022, especially given the circumstances right now. I think this is a good result, even though it's still less than their initial projections. Something to keep in mind, and always I think something worth keeping an eye on in the development of the company and how they progress in the different stages. Now let's have a look at the next slide, since this also gives an overview about the development in the billion of electric miles driven since 2007. Keep in mind for the future reference, and I want to jump over to this slide 21, where they show the non-GAAP gross margin, which has been reduced from 24 in the Q4 2022 to now 17% in Q1 2023. So this is what they think of a strong margin, around 20%. So, yeah. This is something I would disagree, but it's okay if they say it. And another thing which I think is interesting is the operating expenses and how, or as percent of revenue. And as you can see, it's almost between 95 and 116%, almost around 100% of the operating expenses. And unfortunately, it's also in a slight uptrend. Keep this in mind, and this in comparison to the initial investor presentation. As you can see over here, it's a clear decline of the operating expenses percent of revenue, and they aimed to have 65%, sorry, in 2022. And if you jump over here, this is around 1%, I guess. So it's definitely way higher than they expected, and also they forecast around 44% for 2023, which I think is highly unlikely given the beginning with more than 100%. So this would also mean if the percent of revenue they have for operating expenses is higher than expected, then their results will be lower in general. And therefore I want to jump back over to their initial investor presentation, and as you can see, they wanted to be almost adjusted EBITDA positive in 2023. So I think this will be a lot worse than expected. And yeah, keep in mind it's still adjusted EBITDA, so it's no positive free cash flow. And then let's jump back over here. I think there's only one part. Yeah, it's the net cash, and the net cash used in operations is around 70,000 and 70 million, sorry. And if you have a look over here at their net cash balance down here, it's 540 million, so it's almost 7/4 at best. It's most likely less because the stock it's not in cash, it's probably in cash equivalents and restricted cash or something like this, so keep this in mind. Now let's jump over to the news, and as you can see, they confirm full year revenue guidance between 450 and 500 million for fiscal year 2023, which I mentioned before. They said that higher margin offerings have been performing less or worse than their lower margin products, and therefore due to the product mix the gross margin was reduced, and also due to supply chain disruption, which means higher costs and lower supply availability. That's the reason for their decrease in their margin. Stock-based compensation is around 19% of their revenue, of 15.5 million compared to around 89 million in revenue. And the balance sheet, as I mentioned before, 541 million. For the second fiscal year, quarter of the fiscal year, they expect revenue between 96 million and 106 million. And this is almost all of the relevant infos in the text. I'm going to jump over to the balance sheet a little bit. As you can see, their revenue almost double. As you can see, it's to all the segments, and the development is almost the same. The network charging system has a little bit better development than the others, but it's hard to see that they all increase. You'll see the gross profit is higher than the year before, so this is almost positive. And down here, the total operating expenses has been almost doubling as well. And as you can see, the loss from operation almost doubled as well. But this is bad in my opinion. And net income is not really comparable because there has been one-time events in the history. Down here, the EPS has been better than before. It's slightly less negative than before. However, as you can see over here, the number of shares outstanding has been increased dramatically. So it's almost 110 million more, which that means it's almost 50% more. So keep this in mind, and also this is makes the EPS per share look better than it is actually. Keep this in mind when looking at EPS per share. Yep, I think what's good is the cash and cash equivalent has been increasing from this case. It's from the last quarter, and here they compare the same month from year over year. It's also something to keep in mind. And as you can see here, the debt has been raised. So this is the reason for their better balance sheet. Yeah, and to sum it up, I'm a little bit surprised to see, mentioned before, the operating expenses. I'm surprised to see that the company held up pretty well, despite their, in my opinion, worse than expected development. So I wouldn't be surprised to see the company, the share price of the company go lower in the future, even though that they have headwinds from the different developments on one hand side, the ESG part, and on the other side, unfortunately, from the war between Russia and Ukraine. So this is something to keep in mind, and however, I'm not really thinking that they will be cash flow positive before, say, where is it? Fiscal year 2025, which still is around 3 years away. So I think it's, in my opinion, it's too early to get into the company right now. However, I will still be following, because I think right now it's in my opinion the best company for the EV charging space right now. Despite this, please keep in mind this is no financial advice. This is my personal opinion only, and you have to do your own due diligence, and this is no ask for you to buy or sell anything. Until next time, I hope you like the video, and have a good day. Bye bye.